the crypto industry is easy to move to the UK. So if the US screws this up, Coinbase will, sure, be a US listed company, but its main operations will be in the UK. Same for many of these businesses. And I think that's very, very interesting. Germany's already doing a good job with regulation. Switzerland's done a great job with regulation. France is trying to do a good job with regulation. France is pioneering Web3 via LVMH. Bernard Arnault is the richest man in the world. Louis Vuitton Moet Hennessy is one of the biggest companies in the world. That's a fashion luxury goods. They've embraced Web3. All the Arnault kind of siblings are all involved. The kids, they're all involved in Web3. And I think we will see more of the fashion brands and more of the industry based out of that.
The Actual Vision co-founder and CEO, Raoul Pal, takes over to give us an update on the state of the global markets, the big picture outlook, and how regulatory arbitrage may cause the demise of cryptocurrency in the United States. He also discusses the various elements that are influencing global markets, such as inflation data and the ongoing collapse of supply chain tensions, indicating that CPI will return to below 2% sooner than most people anticipate. He points out that the New York Fed Global Supply Chain Pressures Indicator has declined dramatically and is currently 5 months ahead of CPI. A further disappointment was the US PPI, which indicates that the CPI should already be reflecting 3% growth over the following 1 to 2 months. In the United States, small firms are reporting a sharp drop in pricing, and NFIP hiring plans are continuing to trend lower, according to the most recent data, suggesting that unemployment will start to rise very soon. A further indication that pay inflation is a thing of the past is the fact that mfib compensation plans are still decreasing. Additionally, Raoul Pal discusses UK regulatory arbitrage in relation to cryptocurrencies. Let's watch the video and listen to Raoul Pal as he shares his ideas today.
This is actually global liquidity. And now look at that fit. That fit is staggering. That fit is so good, you can't argue that there is not a very, very close ongoing relationship. And anybody who says, well, correlation is not causation, listen, you're missing the whole point. Tied in with global liquidity is equity markets. Now, when you say, oh, well, they print money and therefore money flows into stocks, is simply not provable by the volumes in stock markets. What actually happens is the Venezuelan situation where you debase the currency and the stock market automatically adjusts in price. And that's a phenomenon that you see when there's excess supply of money around. And you see it even in your neighborhood. You saw the houses didn't trade at this price, this price, this price. They went from here to here after the printing. That was the change of the valuation of house prices based on the redenomination of assets. So NASDAQ and global liquidity, now the GMI Global Liquidity Index is a combination of the G5 central bank balance sheets plus money supply and other measures. And it's staggeringly good. If this is the key driver of asset prices, then all we need to know is what's happening to liquidity. So the next chart reveals a bit more about it, which is the chart of the year-on-year rate of change of that Global Liquidity Index. So you can see global liquidity came sharply lower. That brought all financial markets down. The NASDAQ, being highly correlated and a leverage play, came down more. And crypto, which is even more a leverage play on liquidity, plus the adoption curve, as is NASDAQ, because technology adoption is massive right now. They came down a lot. But as that turned, so did markets turn. And this is where people are scratching their heads. I don't believe it. The market should be going lower. Can't you see there's a recession coming? Oh my God, can't you see that earnings are coming lower? Yes, yes, yes. The market knows it all in advance and it already is priced. And I've put that out many times, both on Twitter and here on Real Vision, that the markets are forward looking and there is this uptick in liquidity was actually forecast by our GMI indicator, our financial conditions indicator, back in March of last year, showing that we would start bottoming and coming up from this level. The economy will follow suit. We're probably in a recession now, and then we'll have the kind of final stages of the bottom of the cycle, and then it claws its way back up again and doesn't become positive, let's say, till the end of the year, where GDP growth is positive again, but we'll have unemployment staying very sticky and prices coming lower. This is the S&P 500 against the G5 central bank balance sheets. And this shows that this is a kind of a plot chart to show correlations, and we've got a correlation of 97%. So there is no argument liquidity is the key driver. You can argue against it. You may hate it, but it is what it is. So once you understand liquidity is everything, you stop worrying about all of the things that you think should work as a model. Liquidity drives everything, not your model, not valuations, not anything else. It's all irrelevant. And it took me a while to understand this or even believe in it, but now I've seen it, I can't unsee it. And that everything code I wrote in Global Macro Investor, I won't be really sharing publicly for quite some time, I think is the real answer to all of this. Crypto regulations, we've seen Gary Gensler today, total shit show, being questioned about is Ether security, all of this stuff, refuses to say anything. You know, I think the questions asked were pretty right, is why can you not give guidance to people? Do you want to drive away innovation from the United States? And that is what I've been talking about for a while. I've talked about on Daily Briefing, I've talked about on Real Vision, I've talked about on Twitter, is I think the UK is almost uniquely positioned to take a lot of the crypto businesses. We saw Brian Armstrong from Coinbase over in the UK talking to the government, and that is not the only organization that's been over there. And you see, we've seen this before. England has one great trick. It has a incredible financial system, democracy, and they speak the English language, and they have great trade linkages with the entire world. So when the US stumbles, particularly in financial markets, the UK picks up the slack and does something called regulatory arbitrage. It happened really predominantly first when the US came off the gold standard and had capital controls, because they wanted to limit the flow of dollars in this new world. The foreign exchange markets became the new market in town, because before that everything was pegged to gold. And the UK captured that market, became the largest market the world had ever seen. Then the next phase was the US restricted bank lending, or lending to foreign counterparts. And the UK picked that up and developed something called the Eurodollar market, which you've heard from everybody from Jeff Snyder to myself talking about. The Eurodollar market is the offshore lending of dollars. It is the largest lending market on earth and is gigantic. Yeah, hundreds of trillions of dollars. The FX market trades trillions of dollars every day. And then after that came another little trick from the UK, which was they saw that the US bank regs didn't allow for the use of capital in derivatives in an efficient way, so it was impossible for US banks to get involved in derivative markets. So the UK changed their banking rules. And they changed their banking rules over something called Big Bang. The Europeans followed suit, and the entire derivative market outside of the futures market, so we're talking about the really big markets, the swaps, the OTC markets, all went to the UK, where the UK became the epicenter of everything. All the US banks at this stage, over the 90s and 2000s, after Big Bang, which was the deregulation of the banking industry in the UK, everybody moved to the UK to set up business. So Goldman's main office, London. JP Morgan's main office, London. Morgan Stanley's main office, London. Merrill's main office, London. Credit Suisse, London. SocGen, London. Paribas, London. HSBC, London. Everybody went to London because that was the center of the global financial markets. That changed after Brexit and changed after the Basel III agreements on regulatory use of capital within the banking system. But here we are again. There's a $1 trillion industry called crypto. It has been $3 trillion at peak. This is not a small industry, and most people project it to grow to, let's say, 10 trillion would be gold. Now, gold is based in London as well, regulatory arbitrage. And then if you look at other major asset markets, they're 100 trillion plus, and stuff like the derivative markets are like quadrillion dollars. So the UK is looking at this thinking, okay, we need a relevancy in this world. We lost most of it because of our divorce from Europe and then having to renegotiate trade agreements with every country in the world because we didn't have the European agreements, all of this, and also the loss of manufacturing in the UK and the loss of the financial industry. So here is the UK's gift, and the UK have taken it.
How will this affect cryptocurrencies in the United States, in your opinion? Please share your thoughts with us in the comments area below. Do not forget to subscribe, like, and enable notifications. I appreciate you guys for watching this video.